The United States is in the middle of the most significant trade war in 40 years. Tariffs are reshaping supply chains across every major industry. Costs are rising. Margins are being squeezed. Volatility is spiking. And financial media is doing what it always does, generating maximum noise with minimum clarity. Warren Buffett has seen trade wars before. The Smoot-Hawley tariffs of 1930, the steel tariffs of 2002, the US-China trade escalations of 2018. In every case, the financial press declared it a crisis. In every case, Buffett's response was the same. He did not panic. He did not hedge. He did not exit the market. He looked at which businesses were genuinely threatened and which ones only appeared threatened, and he moved accordingly. In this video, I'm going to walk you through exactly what Buffett does when tariffs hit, the 5 moves he makes, the businesses he protects, the opportunities he looks for, and the specific question he asks about every holding in his portfolio when trade policy shifts. Move 3 is the counterintuitive one. It's what separates how Buffett thinks about tariffs from how almost every other investor responds. Stay with me. Before we get into the specific moves, let me tell you what Buffett has actually said about tariffs because it's more nuanced than most people expect. Buffett is not a free trade absolutist. He has acknowledged that trade policy is a legitimate tool of economic competition. But he has also been consistent in his view that tariffs function as a tax. They raise costs for domestic businesses that rely on imported inputs, and they raise prices for domestic consumers. His 2025 annual shareholder letter addressed trade directly. He described tariffs as a mechanism that transfers wealth from consumers to the protected industry, and noted that the long-term economic cost of sustained protectionism typically exceeds the short-term benefit to domestic producers. But here is the critical point, and the one most financial commentary misses entirely. Buffett does not invest based on trade policy predictions. He does not try to predict whether tariffs will go up, go down, or stay flat. He does not adjust his portfolio based on political forecasts. What he does is look at each business he owns and ask one specific question. Does this business have the pricing power to pass tariff costs through to customers, or does it have to absorb them? That single question determines which businesses are genuinely threatened by tariffs and which ones only appear threatened because their stock prices have fallen. In 2026, with tariffs on steel, aluminum, semiconductors, consumer goods, and agricultural products all elevated simultaneously, the answer to that question varies dramatically across Berkshire's portfolio. Here are his 5 moves. Identify pricing power who can pass costs through. The threat. When tariffs rise, production costs rise for any business that uses imported materials, components, or finished goods. A manufacturer using imported steel faces higher input costs. A retailer sourcing products from overseas factories faces higher procurement costs. An airline buying aircraft with imported parts faces higher maintenance costs. The question is not whether costs rise. They almost always do when tariffs are elevated. The question is whether the business can raise its prices to offset those costs, or whether competitive dynamics force it to absorb them. Buffett's response. This is exactly why Buffett has spent 60 years building a portfolio centered on businesses with genuine pricing power. Brands, utilities, insurance companies, railroads, and consumer staples that customers will pay more for rather than switch away from. Coca-Cola, which we covered earlier this week, is the purest example. When Coke's input costs rise, whether from sugar tariffs, aluminum can tariffs, or anything else, it raises prices. Consumers grumble briefly. They keep buying. The margin is preserved. Geico, Berkshire's insurance subsidiary, similarly has the ability to reprice policies annually, passing cost increases through to policyholders in the next renewal cycle. BNSF, the railroad, operates in an industry with limited direct competition from overseas, making it largely insulated from import tariffs on its core business. Buffett's businesses are not immune to tariffs, but they are far better positioned to absorb and pass through tariff-related cost increases than the average publicly traded company. What you do. For every business in your portfolio, ask, if input costs rise 10% due to tariffs, can this company raise its prices by 10%? If yes, the business is tariff resilient. If no, you need to understand how much margin compression is possible and whether the current valuation accounts for it. Move 2 is about domestic exposure and the specific types of businesses Buffett gravitates toward when trade uncertainty rises. Favor domestic businesses over global supply chains. The pattern. Look at Berkshire's major acquisitions and investments over the past decade. BNSF Railway, entirely domestic. Berkshire Hathaway Energy, primarily domestic utility assets. The insurance businesses, largely domestic risk pools. The consumer businesses, overwhelmingly US-facing. This is not accidental. Buffett has consistently favored businesses whose operations are primarily domestic. Not because he is anti-global, but because domestic businesses have simpler exposure to trade policy risk. They are not caught in the crossfire of tariff escalations between competing governments. The 2026 implication. In the current tariff environment, businesses with complex global supply chains face two distinct risks. The direct cost risk, imported inputs becoming more expensive, and the uncertainty risk, not knowing what trade policy will look like in 12 months, making capital allocation and planning extremely difficult. Domestic-focused businesses face neither risk to the same degree. They source domestically, sell domestically, and face a single regulatory environment. In a trade war, simplicity is an advantage. This is one reason Buffett's major addition to the portfolio in recent years, Occidental Petroleum, is a US-based domestic energy producer. The thesis is straightforward. Regardless of what happens to global trade policy, domestic energy production serves domestic demand. What you do: map each of your holdings to its supply chain exposure. Businesses that source domestically and sell domestically are most insulated from trade war volatility. Businesses that source internationally and sell domestically face the worst combination: rising costs with limited ability to pass them to consumers who can buy domestic alternatives. Move 3 is the counterintuitive one, what Buffett does with businesses that appear to be threatened by tariffs but actually aren't. By the apparent victims, tariff fear creates mispricing. The counterintuitive insight, the peak move. When tariffs escalate, markets respond predictably. They sell stocks that appear to be exposed to tariff risk. Consumer goods companies, manufacturers with international supply chains, retailers sourcing from affected countries, all see their stocks fall, often dramatically, in the weeks following a tariff announcement. This selling is often indiscriminate. The market does not carefully distinguish between businesses that are genuinely impaired by tariffs and businesses that simply appear to be impaired because of their industry or supply chain structure. Buffett's move in these moments is to look precisely at the businesses that have fallen hardest and ask the pricing power question again. If the answer is that the business can pass through costs, the stock's decline is a gift, not a warning. Historical evidence. The 2018 to 2019 US-China trade war provides the clearest recent example. When tariffs on Chinese goods were announced, the market sold off broadly, including businesses with minimal actual exposure to the affected products. Berkshire Hathaway quietly added to positions in several consumer businesses during this period. Not because Buffett disagreed with the market's assessment of which industries were affected, but because he concluded the market was overestimating the earnings impact on specific businesses with genuine pricing power. His framework: separate the price event from the earnings event. If a business's stock falls 20% but its earnings will only fall 3%, and those earnings will recover once supply chains adjust, the 20% price decline is not justified by the 3% earnings decline. The gap between the two is the opportunity. What you do in 2026. Scan your watch list for businesses that have fallen significantly since tariff announcements. For each one, do two things. First, estimate the actual earnings impact of the tariffs, not the theoretical maximum, but the realistic impact given the business's pricing power, supplier alternatives, and inventory position. Second, compare that earnings impact to the stock's price decline. If the price has fallen far more than the earnings, you have a potential opportunity. This is not easy. It requires separating genuine fundamental impairment from market sentiment overreaction. But it is precisely the analytical work that Buffett's framework is built to reward. Move 4 is about what Buffett does with Apple, the one holding in Berkshire's portfolio that has the most complex tariff exposure of any position he owns. The Apple question: when tariff risk is structural, not temporary. The specific exposure. Apple is Berkshire's largest remaining equity position, and it is one of the most tariff-exposed large companies in the world. The majority of Apple's hardware, iPhones, iPads, Macs, AirPods, is manufactured in China and assembled in China or India. Tariffs on Chinese manufactured goods directly impact Apple's cost structure in a way that most of Berkshire's other holdings are not. Apple does have pricing power. It has consistently raised iPhone prices and maintained demand. But there is a limit. At some price point, even the most loyal Apple customers consider alternatives. And tariffs that significantly increase manufacturing costs can push Apple toward that limit. Buffett's response. We covered Apple's sale extensively in an earlier video in this series. But the tariff context adds a dimension that deserves specific attention. Buffett began reducing the Apple position before the current tariff escalation. But his explanation for the sale's valuation, tax efficiency, concentration management, did not explicitly mention tariff risk. Whether that risk was part of his thinking is not publicly known. What we can observe is that at 30x earnings, Apple's current valuation leaves very little room for margin compression from tariff-related cost increases. A business priced for optimism that faces structural cost headwinds is exposed on both dimensions. Current earnings may fall, and the multiple applied to those earnings may also compress. Buffett's remaining Apple position is large enough that he clearly has not abandoned his conviction in the brand and the business. But the reduction is consistent with the tariff environment. If input costs rise structurally and pricing flexibility is constrained, the margin of safety at 30x earnings is thinner than it was at 10x earnings in 2016. What you do. For any technology hardware holding with significant China manufacturing exposure, model two scenarios. One where tariffs persist for 3 to 5 years requiring supply chain restructuring, and one where they are resolved within 12 to 18 months. How different are the earnings outcomes? How different are the valuations implied by those outcomes? If the range of outcomes is wide and you're already paying a premium multiple, the risk-adjusted case for holding becomes weaker. Move 5 is Buffett's long view on trade, and it reveals why, despite everything, he remains the most consistently bullish long-term investor on American business. Never bet against America, trade wars end. Compounding doesn't. The long view. Buffett has said, repeatedly and without qualification, that he would never bet against America. Not as a political statement, as an investment thesis. His argument is this. The American economy has survived and ultimately thrived through 2 world wars, a Great Depression, multiple financial crises, oil embargoes, inflation spikes, political dysfunction, and every form of trade conflict imaginable. In every case, the underlying productive capacity of American business has eventually reasserted itself. Trade wars, by historical standards, are temporary. The Smoot-Hawley tariffs of 1930, the most economically damaging in U.S. history, lasted effectively a decade before being unwound. The steel tariffs of 2002 were removed within 18 months after WTO rulings. The 2018 to 2019 U.S.-China escalation was partially resolved within 2 years. The businesses that produce goods and services that people genuinely need, that have real competitive advantages and real earnings power, have always recovered from temporary trade disruptions. Always. The 2026 application. In 2026, the tariff environment is generating genuine short-term pain across many industries. Supply chains are being restructured at significant cost. Margins are compressed. Some businesses will not survive the transition. But Buffett's framework asks a different question than, will tariffs hurt business? Of course they will in the short term. The question is, in 10 years, will the businesses I own today be worth more than they are today? For a railroad like BNSF, which transports the physical goods of American commerce regardless of where they originate, the answer is almost certainly yes. For a consumer brand like Coca-Cola, whose pricing power survives inflation, recessions, and trade wars alike, the answer is almost certainly yes. For an insurance business like Geico, which insures the cars that Americans drive regardless of trade policy, the answer is almost certainly yes. Tariffs change the quarterly earnings of American businesses. They do not change the long-term compounding of American business quality. And Buffett has never confused the two. What you do. When trade war headlines dominate the news cycle, apply Buffett's 10-year question to every position you own. Not will tariffs hurt this business? They probably will temporarily. But will this business be worth more in 10 years than it is today? If the answer is yes, and you've confirmed that the business has the pricing power and competitive durability to absorb short-term cost pressures, then the tariff-driven price decline is noise. And noise in great businesses bought at reasonable prices is the raw material of compounding returns. That is Buffett's tariff playbook. It is the same playbook he has used for 60 years. And in every trade war of the last century, it has worked. 5 moves, 1 framework, applied to the most significant trade disruption in 40 years. Let's bring it together. Move 1. Identify pricing power, which businesses can pass tariff costs through to customers, and which ones have to absorb them. That single question determines genuine tariff exposure. Move 2. Favor domestic businesses. Companies with simple domestic supply chains face less cost risk and less planning uncertainty than those caught in the crossfire of trade escalations. Move 3. By the apparent victims. Tariff fear creates indiscriminate selling. The businesses that fall most are not always the businesses most genuinely impaired. The gap between the price event and the earnings event is where opportunity lives. Move 4. Assess structural versus temporary risk. For businesses like Apple with complex China manufacturing exposure, ask whether the supply chain risk is a temporary policy friction or a multi-year structural cost headwind. The answer changes the valuation significantly. Move 5. Never bet against America. Trade wars end. They have always ended. The businesses with genuine competitive advantages and real earnings power have always recovered. The long-term compounding of American business quality is not disrupted by trade policy. Here is the final thought I want to leave you with. Every major market disruption of the past 60 years, oil shocks, financial crises, pandemics, geopolitical conflicts, trade wars, has generated the same pattern. Short-term fear, indiscriminate selling, a period of genuine economic pain. And then the businesses with real advantages, real earnings power, and real competitive moats have recovered. And the investors who held them through the noise have been rewarded. Buffett's response to tariffs is not a specific tactical move. It is the same posture he has maintained through every disruption of the past 6 decades. Patience, discipline, pricing power, long-time horizon. The noise changes every year. The framework never does. This has been the 4th week of our Billionaire Investor series. If you've watched from the beginning, thank you. The full playlist is in the description. And if this is your first video, the series starts right here.